Welcome to the first module in the Harmonic Mastery course. My name is Lewis Glasgow and I am the creator of Six Figure Capital. Now, as a Six Figure Capital student, you will have completed the 14-day course prior to the Harmonic Mastery course. If you haven't already, go ahead and do that just now and then progress towards the Harmonic Mastery. If you've done the 14-day course, you can agree that this was a hand-holding guide on how to trade successfully, the foundation for successful trading. Now, the Harmonic Mastery course will not be the same. You won't see any rookie mistakes. They are way behind us now. You're now into the advanced level content. From here on out, it will be intermediate to expert level content that will be provided. So I'm just giving you a heads up that for the average individual that may be difficult to understand, or you may find it very hard to apply. But I'll do my best to break it down and make it as simple as possible. Today's module is the method and the madness, and we're going to be exploiting the natural form of the financial markets. Now, I'm breaking this down into 4 topics. First of all, we will cover harmonic trading methodology, followed by the history of Fibonacci, nature by numbers, and finally, Fibonacci ratios. Now, one question that crops up a lot is, what truly makes a pattern harmonic? And this is probably the most misunderstood concept in harmonic trading, because most people believe it's based on just number 1, Fibonacci and harmonic ratio measurements. And that's what we know as of now. That's what we've been doing. And you can have successful opportunities just measuring Fibonacci by using Fibonacci and harmonic ratio measurements. However, what truly makes a pattern harmonic is these measurements in combination with sine wave structural assessments. And this will be broken down in the Method and the Madness Part 2, where I'll go over sine waves in the financial markets, cosine waves, and really the AB equals CD measurement that we use in harmonic trading. So, as I mentioned, it is one of the most misunderstood concepts about harmonic patterns. The misunderstanding that they are based upon ratio measurements alone. So we utilize distinct and consecutive Fibonacci ratio alignments, but we also utilize these sine wave structural assessments, and that's truly what makes a pattern harmonic. Now, today we will be exploiting the properties of Fibonacci numbers in relation to the financial market. So we're only focusing on number 1 today, and in part 2 of the Method and the Madness, this will be focused on the structural essence of harmonic patterns and sine waves in the financial markets. Now, the harmonic trading methodology provides a framework unlike any other. It's extremely precise. It optimizes every instance of a trade, and I'm just going to highlight why it's so precise. We have the alignment of Fibonacci measurements, so all patterns can be differentiated by their specific set of Fibonacci measurements. Not all patterns are the same. I would go as far to say that no patterns are the same. Every single pattern has a different message. The potential reversal zone. This is a defined area for a reaction with an expectation of a reversal. So I just want to point out here a very critical topic that we're on. Every single pattern, or at least 90% of patterns, will quantify some type of reaction, but it's our responsibility as traders to confirm the reversal. So there will be some type of reaction upon completion of the pattern. It may go sideways, it may stall, we may see a short-term reversal, followed by price hitting our stop loss. We may see an aggressive reversal and price hits our second take profit level. We will see some type of reaction, but it's our responsibility to confirm that reversal. That's why I put a lot of emphasis on using confluence in your trading. That's why I made one whole day, day 11, just for market confluence. I feel it plays a huge role in trading, no matter what your methodology is. But harmonic trading provides a framework, and we're just looking to confirm the reversal. So the PRZ is a critical zone where several Fibonacci measurements converge. They all align, and that's why it makes it such a powerful area for a reversal to take place. It defines an area of strong support or resistance. We have distinguished price points. Every individual price point in a pattern defines the validity of the trading opportunity. So we know that, let's say, a bat pattern, for example, if the B point was only 0.2, we know it's not valid, even if all the other points match up. So that is really what I'm talking about when it optimizes every stage of the trading process. We know what defines a valid pattern. We have all our ratio measurements, our potential reversal zone. We know where to execute the trade. We have these alignment of Fibonacci measurements that converge in the PRZ. Now, something that's new to you guys is IPO, initial profit objective. Now, don't get this mixed up with the term IPO, which is in relation to the stock market. This stands for initial public offering. So when we're talking about IPO and the harmonic trading methodology, IPO represents the first area to consider taking profits. And this most frequently is either 0.382 or 0.618. Now, up until this point, the 0.382 level is a management level. We've been moving our stop loss into break even or into small profit at the 0.382 measurement. And then we look to take full profit at 0.618. Now, just to provide another strategy before you go through the whole Harmonic Mastery course, once price hits 0.382, you can actually consider reducing your position by 50% and moving your stop loss to break even. That way you're securing profits at the first target, and then the other 50% you would leave to run, and this would either hit 0.618 or you would get taken out at break even. So this way you're booking consistent profits along the way, rather than leaving your full position in the market. This is just an alternative to those who want to reduce risk in their trading. They're more focused on the long term. That would be an excellent strategy for you. But don't worry, I'll go in far more detail than this once we get to later modules in the Harmonic Mastery course. Number 5, profit protection zone. So once achieving short-term profit targets, we can cover our position to prevent any losses. So as mentioned just previously, we move our stop loss into profit or into break even, to protect our position. So never let a profit turn into a loss. The stop loss zone. This is the area beyond the potential reversal zone that defines an invalid setup. So once price action exceeds the reversal zone, the loss will be taken. So a stop loss is absolutely crucial in trading, no matter what your trading strategy is. It should always be used. It protects us from incurring large losses in the market, and it protects our capital. Now, the harmonic trading methodology has 3 stages. Number 1, trade identification. You look for a valid setup, an M or W formation in the market. Is it valid? Do all the measurements align? Is the B point valid? The C point, the D point, the X to D? Then number 2, we execute upon that trade. And then number 3, we manage the position. Trade identification, trade execution, trades management. A very simple system. And I'll elaborate on this once we get to our trade management module, or trade management system. And then finally, the defining element of 5-point structures, and this is something I've not told you previously. The B point provides the correct expectation. It distinguishes bats from Gartleys and butterflies from crabs. So you know if you've got a 0.618 B point, it can't be a bat. It's more than likely going to be a Gartley formation. If you have a 0.786 B point for a butterfly, you know it can't be a crab. Very simple stuff, but these are all things that we can use to provide the correct expectation, to get the correct outcome. Now, harmonic trading can offer information regarding the potential state of price action unlike any other methodology. I feel like other methodologies would find it hard to match up to the power of harmonic trading and what it can really offer by optimizing every single stage of the trading process. The utilization of distinct and consecutive Fibonacci ratio alignments defines critical zones where reversals may complete. And as mentioned previously, there will be some type of reaction. Every pattern will quantify a reaction or some type of reaction, but it's our responsibility to confirm that reversal, and that's when we make profit. Now, harmonic trading is based upon the principles that govern natural and universal growth cycles. As seen in many of life's natural growth processes, Fibonacci numeric relationships govern the cyclical traits of development. We will cover this in greater detail in today's module. So this is really why harmonic patterns work in the financial markets. But as mentioned, we'll cover this in far greater detail once we get to nature by numbers. In relation to the financial markets, Fibonacci measurements can define the extent of price action with respect to natural cyclical growth limits of trading behavior. So that's what we're measuring. We're measuring trading behavior, the way in which traders enter and exit positions. Trading behavior is the action of buying and selling influenced by the fear and greed of market participants. The financial markets generally move in cycles that exhibit key stages of growth and decline. If you think back to Day 13, we went over trading psychology, the 14 stages of investor emotions. Half of these emotions exhibited greed-related emotions, and then the other half was fear-related, such as depression. And then for greed, we were looking at euphoria, thrill, excitement, fear, as well as capitulation, looking at despondency and many other emotions as well. So we can actually utilize that and analyze that entire cycle. We must correctly interpret this information, and this is the most important part, and use it to our advantage in order to consistently turn over a profit. Now on to our second topic for today, the history of Fibonacci. In this topic, we're going to be looking at the Fibonacci ratios we use in the financial markets and how they're calculated. Fibonacci numbers are based upon the Fibonacci numerical sequence, which was discovered by Leonardo of Pisa, better known as Leonardo Fibonacci. He is also known as Leonardo Bonacci and several other names. He was an Italian mathematician born in the 12th century, around 1170 to 1180, and he was considered the most talented Western mathematician of the Middle Ages. His work is truly groundbreaking. His most famous work, the Liber Abaci, also known as Liber Abaci, the true pronunciation isn't clear, and this was published in the 13th century. It was one of the earliest Latin accounts of the Hindu Arabic number system. In this work, he developed the Fibonacci numerical sequence, which is historically the earliest recursive series known to date. The series was devised as the solution to a problem about the breeding of rabbits. So here is the Fibonacci sequence. This is what it's based upon. If a newborn pair of rabbits requires 1 month to mature, and at the end of the second month and every month thereafter reproduces itself, how many pairs will one have at the end of n months, the number of months? The number of pairs of rabbits that are produced at the start of each month is 1, 1, 2, 3, 5, 8, 13, and so on. And each new number in the series is formed by adding the two previous numbers. 1 plus 1 equals 2, 1 plus 2 equals 3, 2 plus 3 equals 5, and so on. And this is where the Fibonacci sequence came into play. 1, 1, 2, 3, 5, 8, 13, 21, and this just continues until infinity. After the 8th sequence of calculations, there is a constant mathematical ratio relationship which remains throughout the Fibonacci series to infinity. And this is where things start to get interesting. If we divide 34 by 55, this gives us 0.618, and this is known as little phi. If we divide 55 by 89, the next two numbers in the sequence, this gives us 0.618 again. If we had to divide 89 by 144, it would be the same again. And the further we work along this Fibonacci sequence, the closer the number gets to 0.618. Of course, there's many other numbers that follow that. It may be 0.618, 235, 982. But the further we work along this sequence, the more precise this number becomes. Now, surprisingly, if we flip those numbers in reverse and take the same numbers as above, and we divide 55 by 34, we get 1.618, which is known as phi, and that is the symbol for phi, or the golden ratio. It's known as many other things. 89 divided by 55 also gives us 1.618. Now, what holds even more relevance to us as traders is the next set of calculations to find 0.382. This is the minimum for a bat pattern, the minimum for a crab as well, for the B point, and 2.618. These are the two numbers we're going to be looking at. The next mathematical relationship is found by skipping one sequence in division. So before, we were using 34 and 55. We were using 21 and 55. We're skipping 34. We could also use 34 and 89. So we can see here 21 divided by 55 gives us 0.382. Flip those numbers, it gives you the inverse ratio relationship, just like it did with 1.618 and 0.618. We divide 55 by 21. This gives us 2.618. A similar ratio relationship can be found in the following calculations. The next Fibonacci number is found by skipping two sequences in division. So we're now taking 21 and we're skipping two numbers, 34, 55, and we're dividing by 89. This gives us 0.236. Now, this isn't a ratio we commonly use in harmonic trading or at all. It may have future purposes, but at the moment it doesn't. It is popular in financial markets though, and it is used in trending based strategies. Now, if we flip those numbers, we get the inverse number, which is 89 divided by 21, and this gives us 4.23. Not a number you guys are familiar with, but 4.23 is infrequently used in wave trading and astro cycles. It doesn't have application in harmonic trading just now, but it's always good just to note the Fibonacci ratios because they may come into play in years to come. Now, this is something I call the Fibonacci cascade. If we multiply by 1.618, we will get the next ratio in the sequence, which is really just surprising. If we times 1.618 by itself, we get 2.618. 2.618 times 1.618, we get 4.23. These are both numbers in the Fibonacci sequence that can be derived from the sequence. The next number is 6.85. Again, we're timesing 4.23 by 1.618. Then 6.85 times 1.618 gives us 11.09. These are all Fibonacci ratios. Even more surprising is if we divide by 0.618, we get the exact same numbers. 1.618 divided by 0.618 gives us 2.618, all the way down to 11.09. 6.85 divided by 0.618 gives us 11.09. Now 4.23, 6.85 and 11.09, I'll touch on those later. They aren't used in harmonic trading, but again, they may come into play in the future. What completely surprised future mathematicians is when they discovered the mathematical relationship between the Fibonacci sequence and the golden ratio, which is 1.618. This is also known as the golden mean, golden number, golden section, divine proportion, or Greek letter phi, which we have defined previously. Fibonacci numbers have shown up in the unfolding of leaves, seed patterns in plants, the family trees of bees, regenerative spirals that occur throughout the human body, and can be seen displayed in the growing shapes of shells and galaxies. Now, at this moment in time, you will be thinking, what in the hell is Lewis talking about? Because you'll be thinking, how does this apply to trading? That doesn't make sense. Many of you may be thinking that right now. And don't worry, it will make perfect sense once we go into nature by numbers. So the golden section, Euclid is a famous Greek mathematician who first put the divine proportion into words. So Leonardo Fibonacci, or Leonardo of Pisa, wasn't the first to have any findings of the golden ratio. There was many years and years and years centuries before him. Now, he divided a line into two sections in such a way that the ratio of the whole line to the larger part is the same as the larger part is to the smaller part. Now, this has been applied in various aspects of life, especially art. So A is the whole line, B is the larger part, C is the smaller part, which I've highlighted in blue. So if you just paint a mental image of that just now, write it down in your book, write it in your notes. Let's assume that the whole line A is 1 inch, the larger section B is 0.618, and this is of course how the golden section was brought into life, and the smaller section C, which is 0.382. Now the unit of measurement is not relevant, only the size of the segments, 0.618 and 0.382, that is really what we're paying attention to here. And that is the equation that we're going to be looking at. And I've got a series of calculations on the next slide that we're going to look at that further advances those previous calculations. If we take A and divide it by B, it gives us 1.618, the golden ratio. 0.618 divided by 382, B divided by C, the larger part to the smaller part, gives us 1.618. B, the larger part to the whole line, gives us 0.618, the inverse of 1.618. The smaller part to the larger part, we're dividing 0.382 by 0.618, gives us 0.618. Translated into geometrical shapes, this proportion magically describes many of the patterns we see in nature. And that brings us on to our third topic for today, nature by numbers. Throughout this topic, I'm going to be explaining how Fibonacci is embedded in everyday life and therefore the financial markets. Up until this point, you may be impressed with the mathematical ratio consistency, impressed with the calculations and how the numbers are derived from the Fibonacci numerical sequence. But how does that apply to the financial markets? I know that's what most of you are thinking right now. That's exactly what my thoughts were when I first found out what Fibonacci was. I was impressed with these ratio consistencies, how they're derived from the sequence, but it was developed in the 12th or 13th century. How does that apply to Forex, commodities, stocks, or even cryptocurrencies in this day and age? And I'll do my best to explain that in this part of today's module. What we're about to cover is a relationship of balance, harmony, and symmetry. Fibonacci is embedded in everyday life. It's all around us, everywhere we go, and many of us have never realized until now. The findings of Fibonacci numbers throughout nature, science, architecture, art, music, and the universe are endless. There are so many examples that I've actually only picked 3 for today's module. The first one is phyllotaxis. This was a study of discernible growth patterns in plants done by R.V. Jean in 1994. A survey of 650 species of plants containing 12,500 specimens displaying spiral or multiple phyllotaxis showed that about 92% of them exhibited Fibonacci-related traits. Our next example is in flower petals. Again, another example in nature. Lilies, irises, and trillium have 3 petals. Again, that's a number in the Fibonacci numerical sequence. Buttercups, larkspur, and wild rose have 5 petals. Bloodroot and cosmos have 8 petals. Daisies can be found with 34, 55, or even 89. Sometimes they will be relatively close to that number. They will be 33 or 35 with daisies, but they will be extremely close to a Fibonacci number. Even the human body has Fibonacci-related traits. In many works of Leonardo da Vinci, the fascinating proportions of the human body have been illustrated. The proportions of the hand possess 5 ratios. Starting from the top of the finger to the base of the wrist, the palm is approximately 61.8% of the entire hand. I can tell many of you are waiting to get the measuring tape and find out for yourself. But yeah, it's true. And in most individuals, the palm will be 61.8% of the entire hand. Now, Fibonacci in the financial markets, this is the most important part. That's what we want to uncover in this part of today's module. As mentioned in our first topic today, Fibonacci measurements can define the extent of price action with respect to natural cyclical growth limits of trading behavior. As mentioned, we're measuring trading behavior. Fibonacci ratios can quantify specific situations where repeating growth cycles of buying and selling exist. It is in the understanding of these growth cycle structures that provides technical information regarding price action. In simple terms, by understanding the patterns. Now, before we go ahead and dig deeper into why Fibonacci works in the financial markets, I just want to add, if you're fascinated by Fibonacci and how it applies in everyday life, in the universe, and throughout nature, art, music, science, and so many other examples, there is a book I highly recommend. It's called The Secret Code. I'll put a link below today's module. Now, I must say, this has no benefit towards your trading whatsoever. It will not make you a better trader, but it will help you better understand Fibonacci and how it works. Its natural application. So if you're interested in Fibonacci, it fascinates you, you want to learn more about the numbers, then I would probably recommend The Secret Code. It's an excellent book. I've got a copy myself, and I highly recommend it. Now, Fibonacci numbers are unquestionably part of a mystical harmony that feels good, looks good, and even sounds good. The financial markets are not a random, formless mess reacting to current news events, but a remarkably precise recording of the formal structure of the progress of human beings. Man and women's collectively expressed emotions are keyed to this mathematical law of nature. The market is a tabulated reflector of mass psychology, and that is what I was talking about earlier when referring to day 13 trading psychology. When we went over fear and greed and the 14 stages of investor emotions, we can actually look at the market and identify those emotional-based trading cycles. And that is truly what we're measuring when we're trading harmonics. These structural formations, these wave formations, that is what they're measuring, is the trading behavior of market participants. In the financial markets, changes in price reflect human opinions, valuations, and expectations of an asset. And this can be any asset at all. It is believed that humans subconsciously seek out the golden ratio, creating perfect geometric relationships in their behaviors. Traders aren't psychologically comfortable with excessively long trends. It's unnatural and does not adhere to the rules of nature. So this is why we have trend reversals, we have corrections, we have pullbacks. It's unnatural for a market to move just one way. Imagine the market just uptrended and never stopped. It's unnatural. We go through bull markets, we go through bear markets as well. When the distance from the golden section becomes excessively long, the feeling of an improperly long trend arises. And this can happen in any market at all. It's seen in stocks, cryptocurrencies as well, when we have these really aggressive moves that are just don't adhere to the rules of nature. And they're extremely out of proportion. And that's why we have these moves that increase by maybe 1,000 or 2,000% within a matter of weeks. And then they decline by 90%. It's absolutely incredible. Now, it's our responsibility to correctly interpret the information and filter it accordingly in alignment with our trading plan. The harmonic trading methodology defines measured zones subject to change in trading behavior. So this is, of course, the potential reversal zone. It's within these zones we see buying or selling activity being absorbed, followed by a market reversal or continuation. As mentioned before, we will get some type of reaction. It may be a reversal or it may be a continuation, but it's up to us as traders to verify which way it's going to be. Now, to conclude on this topic, do not attempt to seek the deep philosophic explanation as to why they work, why Fibonacci works in the financial markets, why it works throughout nature. It's only important you understand their application. Of course, the better we can understand a concept, the better we can apply it. And that's why I recommended the Secret Code as an addition You could read that and better understand how Fibonacci works in everyday life, and of course then better understand how it applies in the financial markets. But the explanation I've provided is sufficient, and it gives you a real understanding of why Fibonacci actually works. Now onto our final topic for today, Fibonacci ratios. The Fibonacci ratios we use in the financial markets can be categorized by primary, secondary, and tertiary ratios, and this is all based upon how they're derived from the Fibonacci sequence or other Fibonacci and harmonic numbers. Now the following primary numbers are directly derived from the Fibonacci sequence. Our primary retracement is 0.618, and this is the defining element of many harmonic structures such as the B point in a Gartley and the perfect AB equals CD. 1.618 is the primary projection or extension, and this signals a state of extreme price action, such as the X to D in a bullish or bearish crab, and an extremely overextended price structure. Secondary ratios, these are derived from the Fibonacci sequence by skipping series in division, or derived from the primary ratios. 0.236, we skip 2 sequences in division. 0.382, we skip 1 sequence in division. 0.786 is the square root of 0.618. 1.272 is the square root of 1.618. 2.618, we skip 1 sequence in division, or it's 1.618 squared. Same said for 0.382, 0.618 squared, or 1 minus 0.618, relating to the golden section. Now onto tertiary ratios. There's far more in this topic. 0.5 is 0.707 squared. 0.707 is the square root of 0.5. 0.886 is the fourth root of 0.618, which is also the square root of 0.786. 1.0 relating to the golden section, 0.618, the larger part, to the smaller part, 0.382. 1.13 is the fourth root of 1.618, or square root of 1.272. 1.414 is the square root of 2.0. 2.0 equals 1 plus 1, the first two numbers in the Fibonacci numeric sequence. There's also other ways that we can calculate 2.0 as well. 2.24, the square root of 5. Now, that's not a topic I'm going to get into today. It has no relevance to trading, I feel, but I'm just displaying the calculation. 3.14 is, of course, pi. If you've done basic mathematics, you'll understand what pi is. 3.618 equals 1 plus 2.618. And that's about it. And it's important to note that not all of the ratios shown are Fibonacci numbers. Many of the derived ratios are not entirely conceived from the Fibonacci numeric sequence. Instead, these are harmonic trading ratios. Regardless, I keep it simple and I refer to them all as Fibonacci ratios, just to save any confusion. And to end on the primary, secondary and tertiary before we head into our next part of this topic, I just want to note that we are not ranking these ratios in order of importance. They are all relevant in the financial markets. They all serve a purpose. They're all defined measurements that we can use in aid of making a profit. It's not to say that the secondary numbers are more reliable than tertiary numbers. I've just organised these in the way they are derived. Many other analysts section these ratios into primary derived and complementary derived. Now, I've made them primary, secondary and tertiary to keep it simple. If there's only one thing you know about me, it's that I love to keep things simple. Although this module has been a total brain burner, I like to strip everything down to its most simple form and keep it as simple as possible if I can. I've also rearranged the ratios as well. Other analysts have ranked these ratios, maybe some tertiary ratios are in the primary derived and some of the secondary are in the complementary derived. I switched them about so it's logical, it makes sense, and these are ranked based on how they are derived, as I mentioned before. And in order to keep your trading simple, I think you should use primary, secondary and tertiary as well. I feel that primary derived, and complementary derived is a bit more complicated, whereas primary, secondary, and tertiary just keeps things simple. Now, these sections reflect the way in which the ratios are derived either from the sequence itself or other Fibonacci harmonic numbers. As I've mentioned previously, the primary numbers are derived directly from the sequence. Secondary numbers, they're derived from the sequence by skipping a series and division, or they're derived from the primary numbers itself. And this is what I've defined. This is what I deem logical. And tertiary ratios, they are derived from the secondary numbers or distantly derived from the primary numbers. Now onto the forgotten ratios. The following Fibonacci ratios are infrequently used in trading. The market research using these specific measurements is minimal in comparison to other numbers. 4.23, we went over this before. 6.85, 11.09. Now I don't want to keep calling out how to calculate these. To be honest, most of you won't be writing this down. But it's just to show how relevant these numbers really are and how they relate to the sequence, how they're calculated. They do have a purpose, rather than just grabbing a number out of thin air, which most people think we do. We don't. They do have a purpose. Now, these ratios, they aren't relevant to harmonic trading, as mentioned before. 6.85, 11.09. I would say that's as far as I would go. We can get numbers further than that. I'm pretty sure the next number is 17.94, if I'm not mistaken. That would be the number after 11.09. That would be skipping 5 sequences in division. And you can keep getting these larger numbers by skipping maybe 5, 6, 7 sequences in division. But we need to look at it from a percentage basis. If we take 11.09, that in a percentage is 1,109%. If you measure from high to low and you measure 11.09, that's an extremely large move. That's a parabolic move. And you won't get that very often in a normal market situation. 11.09, you can use this in things like cryptocurrencies. When you have a bullish cycle and the market increases by several thousand%, you can use ratios like 11.09 and 17.94, but their application in normal trading markets and harmonic trading, they don't hold much relevance. Not just now, but possibly in the future. So as I said previously with 4.23, it may be used in future analysis, so it's worth noting these ratios. Now on to reciprocal ratios. These are based upon the inverse relationships of retracements versus projections and extensions. We can utilize this relationship to identify the expected completion point for harmonic patterns. In specific patterns, the retracement ratio can be used to identify our expected projection extension measurement. So we can take the ratio for C, for example, and then this will give our projection for D. This will hold more relevance once we cover the AB equals CD. We can see how everything seems to operate around this AB equals CD. And as you'll learn in the next module, the Method in the Madness Part 2, we break down the ABCD from a structural sense. But once we get into peculiar patterns, you'll actually be able to apply this pattern in market situations using reciprocal ratios. And we can also use reciprocal ratios for the alternate AB equals CD, not as relevant in that formation. We have the reciprocal AB equals CD and also the 5-O pattern. And this actually has a reciprocal ABCD measurement inside it. But not to confuse you, just focus on the module in hand. Now these measurements define the approximate price levels for the most symmetrical formations. The calculation measures the inverse of ratios less than 100%. And the way we do this is 1 divided by x. So 1 divided by 0.618, for example, this would give us 1.618. This is the inverse ratio relationship. So if we divide 1 divided by 0.618, this gives us 1 divided by 0.618 gives us 1.618. 1 divided by 0.382 gives us 2.618. So when we have a 0.618 retracement, let's say for a C point and a bullish bat, we can then expect the D point to be 1.618. Now, this won't hold much relevance until you learn about the AB equals CD. It applies more to these formations than it does the individual patterns. So I wouldn't worry about this too much until we cover the AB equals CD pattern. So here we have, I promise this is the last bunch of numbers you're going to see today. There's been a lot to take in. It's actually been a lot for me to deliver as well. Now the retracement ratio, we can see here on the left, this defines the inverse relationship for the projection. 0.236, the inverse is 4.23. 0.382, the inverse is 2.618. However, we can have an alternate inverse of 2.24, 3.14, and 3.618. When we're looking at 0.382, my initial thought, or my initial projection is 2.618. 0.5, the inverse is 2.0. 0.618 is 1.618. 0.707, 1.414. 0.786 is 1.272. 0.886, 1.13. And finally, 1.0 is 2. Now, the only one that doesn't follow the 1 divided by x is the last measurement, and that is 1 equals 2. That is the only reciprocal ratio that you can't divide 1 by 1, because this would not equal 2. So it's actually 1 plus 1 in relation to the calculation I provided in the tertiary ratios section. Now, that's a lot of ratios to take in. It's a lot of numbers in this topic to take in. So what I've done is I've put together a harmonic mastery ebook. This covers everything from Fibonacci ratios to reciprocal ratios, Fibonacci ratios displayed as percentages. It covers all of the patterns. It covers all of the risk management rules as well. And just to save you time, I suggest you download that. You can find it in the Traders Resources section underneath Course Bonuses. So if you head over to Course Bonuses, you will see Trader Resources, and then you will see the Harmonic Mastery ebook. And that's got all of the ratios in there. It's going to be your harmonic trading Bible, so to speak. You will use that all the time when you're trading. So your previous harmonic trading ebook, you won't need that anymore. This one is at least 50 pages long. There's a lot of content in there. So I would recommend printing that off, even just keeping it open when you're trading. I'm not going to link it below today's module because there's a lot of patterns in there that you haven't learned yet, but you can find it by going to Trader Resources. So let's just wrap it up. It's been another successful module, extremely lengthy, more in depth than usual, and I'm not entirely sure how to summarize it. It's been, like I said, it's been a brain burner. There's been a lot of in-depth content in this module, but hopefully it's advanced your understanding of harmonic trading and how it's actually applied in the markets. My advice would be to master the application. You only stand to make a profit from the correct application. Now, the better we understand the methodology we're using, the better we can apply it. But when it comes down to it, you only make profit from the correct application. It's like saying knowledge isn't power until it's applied. And that's pretty much what I'm saying here. Don't worry too much about the in-depth characteristics of Fibonacci and how it's applied throughout nature and the meaning behind it in the financial markets. If you didn't understand that, don't worry. As long as you know how to correctly apply the patterns, that is what really matters. So this module will help you understand the meaning behind the way that price moves as it is dictated by human behavior. So that's really what we're measuring here, is trading behavior influenced by the emotions of investors and traders. And I want you to start utilizing reciprocal ratios in your trading, and this will help you when anticipating future price direction. So once you get onto peculiar patterns, I think I've said that module at least 10 times now. You're going to hate me for saying it. Once you get onto that module, that's when you can really start applying these measurements. And again, we will cover this in later modules. We'll cover this in the Method and Madness Part 2, Peculiar Patterns, and many, many other modules after that. I hope you enjoyed today's module, and I'll see you on the next video.